Hey everyone, in this video I'm going to look at GigaCloud Technology, a global business-to-business logistics company, and answer whether or not I think this stock is a buy, hold, or a sell. To answer this question, I'm going to look at the company's revenue, profitability, cash flow, its valuation, and its prospects for the next couple of years to answer if the company is a buy at current prices. So without further ado, let's jump in. Let's take a look at the recent results for GigaCloud Technology.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so in its most recent update on March 15th, GigaCloud Technology told investors that in its fourth quarter, revenue increased by 94.8% to 244 million. That's a phenomenal rate of growth, to be sure. Also, net income jumped to 35.6 million, which was an increase of 184% from 12.5 million in the fourth quarter the prior year. For the full year, total revenue came in at 703.8 million. That was up by 43.6% from the same time period the year before, and net income came in at 94.1 million, which was an increase of 292% from the prior year. So the company's growing revenue, growing profitably, and it's made two recent acquisitions that's going to be a little bit challenging to digest in 2024. But after digesting those two acquisitions, which you paid for it in cash, by the way, I'm going to talk a little bit more about that. I think profitability will rebound in the following year. Let's continue. So its active third-party sellers in the trailing 12 months increased by 45.5%. Active buyers increased by 20%. Now, these aren't just your typical active buyers. These are businesses, right? So their spending per active buyer is much larger than the average consumer. Their spend per active buyer was $158,569, and that was up 27% in the time period before. Now, GigaCloud makes it easier to run an online marketplace without needing to deal with the expensive logistics that GigaCloud provides. If you recall, one of the companies that I had been following for years, Shopify, I had kind of downgraded them because they chose to invest billions of dollars in their logistics and fulfillment facilities. And I was a fan of Shopify's asset-light business model. I didn't want Shopify to enter into that business in investing billions of dollars to try and increase its own fulfillment and logistics network. I don't like when companies try to do that. So GigaCloud Technology is a nice option for companies that want to start e-commerce or are doing e-commerce to have logistics and fulfillment handled without needing to get their hands in to the expensive and complicated logistics network. GigaCloud, that's what they're in business to do. They do this well. They can do this better than any company that's doing this as a supplement or something on the side that it's also doing. It's not in the business of doing, right? So I think it's a good option for businesses that are trying to simplify getting their products to customers and not focus on that and not need to invest so much on that. They can just focus on selling their products, making sales and generating profits through sales and not trying to handle logistics and fulfillment. So acquisitions, I mentioned I would talk about that. There's two big ones to note here. So in October of 2023, they acquired Noble House Furnishings, which is a leading business-to-business distributor of indoor and outdoor home furnishings, and they paid 77.6 million. But the most interesting part is that they paid for the acquisition in cash. Now, you've probably heard me talk about this. When a company acquires another company, there's options in how you acquire it. You can pay cash, you can pay stock. If you pay in stock, it's kind of like telling the world that you feel your stock is overvalued because you're paying in stock, right? You have a choice. You could pay in cash or you could pay in stock. If you pay in stock, you're diluting shareholders and you're essentially selling more stock onto the market and thereby telling the market that you feel your stock is overvalued. You want to use it to acquire another asset. So you're trading essentially your stock for another asset, signaling that you feel your stock is overvalued and you want to give that up in exchange for whatever it is that you're getting. In this case, GigaCloud chose to use cash and not its stock, signaling it doesn't want to part ways with its stock. In fact, they're buying back their stock, which is further solidifying that statement, that silent statement from management that they feel their stock is undervalued. They're using cash to make these acquisitions, and they're using cash to buy back their shares. The second acquisition, where they paid $10 million for, was the WonderSign acquisitions, and they also used cash on hand from operations. So this is a good sign to me, especially when I couple that with the fact that they are also purchasing back their stock. They have a $25 million, I should say, buyback program to repurchase their shares. Looking out a little longer term, their revenue has grown nicely over the years. You can see if I expand this out to the last 3 years, 584 million in revenue in the most recent update, up from around 425 million in the trailing 12-month period of January of 2022. The company's profitable, right? I showed you its net income growth, its operating profit margin, 15.32%, and growing as revenue is growing. I like to see that. Now, this metric might get fumbled up a little bit in the next year as it digests these two acquisitions, but I suspect that it will return to growth after the short period where it will digest the acquisitions. It's never a simple thing to digest an acquisition. You've got new assets coming on board. You've got new people, new teams, figuring out who's going to fit where, who needs to be let go, redundancies, etc., etc. It's never easy. So that always plays a role in profitability in the near term. And then longer term, the hope is that it will be accretive to profitability. So looking out over the next few years, for 2024, analysts on Wall Street expect GigaCloud to deliver earnings per share of $2.41. And for 2025, for it to grow nicely to $3 per share. And you can see here over the last 90 days, the earnings per share prospects for GigaCloud have been rising from $2.26 to $2.41 for 2024 and from $2.85 to $3 for 2025. So investors are getting more optimistic about GigaCloud's earnings prospects for 2024 and 25. Companies generating solid cash flow from operations, 18.65% in the most recent trailing 12-month period, up from less than 5% in January of 2022. So you can see it progressing nicely as revenue is growing. It's turning into more profitability and increasing cash flow from operations, signals of a well-run business. And finally, the stock is trading at a forward price to earnings ratio of 11.39. Now, while this is on the higher end of where this valuation has been going back, let's say, a year over here to January of 2023, I don't think that this stock is overvalued. In fact, I agree with management's silent statement here that they feel their stock is undervalued. I would agree with GigaCloud Technology in saying that their stock is undervalued. So to answer the question I posed in the video, is GigaCloud Technology stock a buy, sell, or a hold? I would say this stock is a buy. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.